Japan just sold off U.S. Treasury bonds again, but this time the move was so massive it triggered a 1.7 trillion market loss. Trump's response, public denial, private panic, and behind the scenes, a scramble that could rewrite America's financial future. So what's really going on here? Why is a longtime ally like Japan suddenly pulling the plug on the US dollar? And more importantly, is this the moment the world stops trusting America's money? Let's get one thing straight. Japan isn't some rogue actor. This is the world's fourth largest economy. And for decades, it's been one of Washington's most loyal financial partners, quietly buying US debt like clockwork. But in January 2025, Japan slashed its U.S. Treasury holdings by $119.3 billion, the steepest quarterly drop since 2012, according to Treasury International Capital, TIC data. Once America's largest foreign creditor, Japan has now ceded that title to China. While the Bank of Japan cited domestic yield curve adjustments, economists like HSBC's Frederick Naumann argue the move was not purely technical. It's a clear hedging strategy against future U.S. fiscal instability. This sell-off followed months of quiet warnings from Japanese officials, frustrated by U.S. trade policy and dollar volatility. Bloomberg reported that Tokyo is actively exploring regional settlement systems denominated in yen, particularly with ASEAN nations. The message is subtle but strategic. Japan is no longer betting on indefinite U.S. financial leadership, and it's preparing alternatives. In November 2024, the U.S. Commerce Department imposed a 25% tariff on Japanese electric vehicles, citing unfair subsidies and national security threats. The move blindsided Tokyo and triggered immediate diplomatic pushback. According to Reuters, Japan's Ministry of Economy labeled the tariffs disproportionate and economically unjustified, while Nissan CEO Makoto Ucha warned this action punishes innovation and disrupts integrated supply chains. The EV dispute intensified after Toyota's solid-state battery breakthrough, offering 750 miles of range on a 10-minute charge, posed a direct threat to U.S. automakers still reliant on lithium-ion systems. The tariffs weren't just about trade, they were a defensive measure wrapped in geopolitics. And Japan's economic retaliation. It didn't involve auto parts, it started in the bond market. The Treasury sell-off was Tokyo's financial version of a sanctions warning without ever calling it that. By Q1 2025, Japan controlled over 48% of the world's solid-state battery patents, according to the World Intellectual Property Organization. Toyota and Panasonic jointly announced a new EV platform with mass market deployment by early 2026, drawing European pre-orders even before launch. Meanwhile, the U.S. lagged behind with Ford and GM facing battery supply bottlenecks and increasing costs from Chinese graphite restrictions. This imbalance gave Japan bargaining power it never had during past trade conflicts. The Wall Street Journal reported that Japanese negotiators are now demanding tariff exemptions in exchange for strategic technology partnerships, signaling a new playbook, trade access in return for energy dominance. EV superiority is no longer just economic, it's political capital, and Washington may soon have to decide whether isolationist tariffs are worth ceding the future of mobility. When a major holder like Japan exits the U.S. Treasury market, it doesn't just create a hole, it destabilizes the floor. In February 2025, 10-year bond yields surged to 4.89%, 89%, their highest since 2007, as foreign demand dried up, according to MarketWatch. The Congressional Budget Office warned this spike could raise U.S. debt servicing costs by $270 billion annually by 2027. PIMCO's chief economist Tiffany Wielding told Bloomberg, "Luing stable buyers like Japan increases Treasury volatility and weakens global faith in the U.S. fiscal trajectory." Meanwhile, the dollar index dropped 2.1% in 2 weeks as central banks from South Korea to the UAE trimmed dollar reserves. The broader impact, higher borrowing costs for American households and businesses, and a deepening suspicion among foreign investors that U.S. debt may no longer be the ultimate safe haven. Japan's $119 billion dump wasn't an isolated tantrum, it's part of a broader trend. Since 2022, the dollar share of global reserves has slipped from 59% to 54%, according to IMF data released in March 2025. Central banks in Malaysia, Brazil, and Saudi Arabia have all increased non-dollar assets, particularly yuan and gold. According to Credit Suisse strategist Zoltan Posar, the architecture of the global financial system is fracturing and Japan's exit is not a crack, it's a break. China's digital yuan now accounts for 5% of cross-border settlements across Southeast Asia. While India's rupee is being used in oil contracts with Iran and Russia, Japan's move accelerates a feedback loop. As trust in the dollar wanes, the need for alternatives grows, raising the risk of a fragmented, unstable monetary order. The question now isn't if a new system is forming, but how fast the old one is unraveling. Between February 3rd and February 6th, 2025, the U.S. stock market lost $1.7 trillion in market capitalization, with the S&P 500 falling 5.4% in just 3 trading sessions, according to Bloomberg. The catalyst: a combination of Japan's treasury dump, spiking bond yields, and worsening trade tensions. But investor sentiment also soured after Trump's administration announced plans for another round of retaliatory tariffs, this time on Japanese electronics and South Korean semiconductors, raising fears of an Asia-wide trade war. BlackRock analysts noted that policy unpredictability is now the primary driver of market risk. While Moody's downgraded its U.S. outlook to negative watch over ballooning deficits and geopolitical instability, whether Trump caused the crash is debatable, but the market's reaction was clear. The combination of aggressive protectionism, deteriorating alliances, and fiscal indiscipline is no longer seen as manageable noise. It's now viewed as systemic risk. Donald Trump touted 2019 as the greatest economy in the history of America. But by 2025, several indicators suggest that the foundations laid during his first term may have increased systemic risk rather than long-term resilience. While GDP peaked at 2.9% in 2018, corporate tax cuts under the Tax Cuts and Jobs Act ballooned the federal deficit to over $984 billion by 2019, and it has since surged to $1.9 trillion in fiscal year 2024, according to the Congressional Budget Office. Economists at Brookings argue that the administration's aggressive deregulation combined with escalating trade conflicts weakened America's position in global supply chains while increasing inflationary vulnerabilities.
Former Fed economist Claudia S. told Bloomberg, "Stimulus with no structural reform created sugar highs, not stamina." The stimulus fueled gains masked underlying instability, setting up a brittle recovery that began to unravel once international confidence in U.S. fiscal management began to erode. While Washington continues to focus on decoupling from China, Canada has been subtly diversifying away from the U.S., its largest trade partner, by accelerating economic integration with Europe and the Indo-Pacific. In the first quarter of 2025, Canada finalized a digital currency interoperability agreement with the European Central Bank and Reserve Bank of Australia, aiming to reduce SWIFT dependency and enable direct digital settlements, according to Reuters. At the same time, Ottawa expanded its critical mineral strategy, signing long-term lithium and cobalt supply deals with Australia and the EU to bypass potential U.S. export controls. Trade volume between Canada and the EU under CDA grew 16% year-over-year, while exports to the U.S. fell 3.4%. StatsCan reported as Canadian Finance Minister Chrystia Freeland recently told the Globe and Mail, "Economic resilience today means not being overly dependent on any single economy, even an ally. Canada isn't turning against the U.S. It's hedging against its instability." In January 2025, Trump imposed a 200% tariff on European wines in retaliation for EU data privacy fines against U.S. tech giants, triggering immediate backlash across the Atlantic. France, Italy, and Spain jointly filed complaints at the WTO and moved to impose retaliatory tariffs on American pharmaceuticals, medical devices, and aircraft components. According to the European Commission, the U.S.-EU trade surplus in goods dropped by $13.6 billion within a month. And Airbus CEO Guillaume Fay warned that if this escalates, aerospace supply chains on both sides could seize up. Meanwhile, California wine exporters saw a 22% decline in EU sales in just one quarter. According to U.S. Wine Export Council data, J.P. Morgan analysts warned the tit-for-tat risked igniting a full-scale trade conflict with America's largest Democratic ally bloc. What began as a symbolic jab over wine has become a test of how far Trump is willing to gamble U.S. trade for political points. In February 2025, the D.C. Circuit Court ordered the Trump administration to pause a new round of punitive tariffs on South Korean chip exports, pending judicial review, citing insufficient national security justification. Trump ignored the ruling. The White House invoked Section 232 of the Trade Expansion Act, despite the court's determination that no immediate threat existed. marking one of the rare instances where a sitting U.S. president has openly defied a federal court directive on trade. Yale law professor Bruce Arian told the Wall Street Journal, "This is not just a trade dispute, it's a direct constitutional confrontation." Legal scholars argue the act was designed for emergencies, not strategic protectionism. On March 2, 2025, Chief Justice John Roberts issued a rare public statement warning against executive overreach in economic affairs after the Trump administration bypassed court reviews on multiple tariff actions. While the court typically avoids political commentary, Roberts argued that ignoring judicial checks undermines global confidence in American institutions. His remarks followed a sharp increase in amicus briefs filed by foreign governments concerned about the erosion of legal predictability in U.S. trade policy. According to the World Bank's 2025 Global Governance Report, the U.S. dropped 5 spots in judicial independence rankings, now below Canada, Germany, and even Singapore. Investors reacted accordingly. Credit Suisse reported a spike in volatility premiums on U.S. bonds, with 5-year CDS spreads widening 14 basis points overnight. Roberts' warning wasn't aimed at partisans. It was a signal to the markets. U.S. credibility no longer rests solely on its economy, but on whether its laws still bind its leaders. The dollar still dominates 54% of global reserves, but that's down from 61.8% 8% in 2020. And the trend line isn't improving. According to the IMF's March 2025 report, 13 central banks, including Brazil, Egypt, and Indonesia, have begun conducting bilateral trade in local currencies or digital alternatives. China's cross-border interbank payment system, CIP, processed over $447 billion in non-D transactions last quarter, a 34% increase year over year. Meanwhile, the BRICS Pay initiative backed by Russia, India, and South Africa is scheduled for full launch in July 2025, offering an alternative payments rail outside SWIFT. Former Fed Chair Janet Yellen, speaking at the Council on Foreign Relations, stated, "We are entering a more fractured monetary era. Dollar dominance won't end overnight, but it's no longer unquestioned. If financial systems increasingly bypass the dollar, the U.S. loses more than transaction fees, loses leverage. And what replaces that leverage? A world with no clear center, just contested spheres of influence where economic rules are written in time." We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your